As an investor, it is critical to follow a clearly defined investment process. I would even go as far as to say that an investor who doesn't follow a proven system, a proven investment framework, is destined to fail. And a good investment framework not only defines what you want to be looking for, no, it also describes what you want to avoid. As Alan Mecham has put it, our investment mentality puts a premium on figuring out what to avoid rather than what to buy. So in today's video, I want to highlight 3 types of companies that I think investors should avoid. And without further ado, let's get started. Alright, hello fellow intelligent investors, my name is René Zellman, and before we get started, if you get some kind of value out of today's video, I would very much appreciate it if you take the 2 seconds it takes to like the video and maybe to hit the subscribe button even if you aren't subscribed yet and want to stay up to date with the content I post on this channel in the future. And with that out of the way, let's get to the 3 types of stocks that I try to avoid. So the first type of company that I want to avoid in my portfolio are companies that are incredibly difficult to understand. So I would say that investors should absolutely favor simple, predictable, and easy to understand businesses over those where you have a hard time actually understanding and figuring out what the company does, how it makes money, and where the business will be in 10 or 15 years from now. And my explanation for this principle in my investment framework is quite simple. If you cannot estimate with a certain degree of certainty where a business might be in a decade from now, you simply cannot value it. And if you cannot value an asset, how do you want to determine which price you can pay for that asset to generate a good long-term return? Well, I think you can't. And thus I would argue that an often underrated investment principle is that limiting yourself and limiting the universe of stocks or potential stocks you allow yourself to invest in can actually lead to exceptional investment returns and results. You don't have to understand everything. Now, without getting into too many details here, what does it actually mean to understand business? When have you reached this point? Well, actually, understanding a business entails a lot of things. For example, describing the firm's products and services, knowing whether the company's products or services are considered to be in the high, mid, or low tier product segment, whether the firm has plans for new products or services, being able to describe a firm's core customers and target group, knowing where the company operates geographically, industry dynamics, and so on and so forth. And again, I could probably do a 2-hour video on how to understand a business and what questions you should be able to answer before you invest any of your hard-earned money into that business. But I think you get the idea here, and actually I think you can probably break it down even further. Just ask yourself the following question. Can you say in a few simple and unambiguous sentences what the firm is doing so that anyone, that could be your partner, your parents, or even your child, can understand the business model? And ideally, you can do that in 1 or 2 sentences. To illustrate this principle, let's consider 2 companies. On the one hand, we have Apple. I would say that most of you will probably be capable of understanding what Apple actually does and how the Cupertino-based company actually makes money. Apple designs and manufactures smartphones, personal computers, tablets, wearables, and accessories, and sells them worldwide under the Apple brand, which is considered to be a premium brand. And in addition, their customers can buy services such as iCloud or Apple Care, and Apple also operates the App Store, which allows customers to discover and download apps and digital content such as books, music, video, games, and podcasts. Now contrast that to pharmaceutical companies with sometimes hundreds of different products for different treatments that the average Joe really cannot understand. They are too complicated. You also have to figure out the complicated drug patent system, the rapidly changing industry that requires constant research and development spending and new innovation, planned new products that have to go through various phases of clinical trials. And I would argue that assessing the potential of new drugs and the likelihood of receiving approval is in and of itself incredibly difficult. And all of this makes it very difficult and I would argue maybe even impossible for the average Joe to predict where pharmaceutical companies will be in 5 years, let alone 10 or 15 years, unless you are an expert in this field. Now, another example that comes to mind is Alibaba. Some of you probably know that I do have a small position in Alibaba, but nonetheless, I would argue that, Alibaba as a business is incredibly difficult to understand. On the one hand, understanding a Chinese company in general and Chinese consumer tastes as someone who's not living in China is in and of itself very challenging. But moreover, the structure of Alibaba's business is also unbelievably complex. There are dozens or actually hundreds of subsidiaries, I think around 270. And the legal structure is also quite overwhelming, as this chart here shows. So even if you do feel like you understand the business and how the company makes money, you might want to size your position accordingly to reflect that you might actually misunderstand certain parts of the business and its long-term runway. All right, let's finally get to the second type of company that I try to avoid. So another type of company to avoid are those businesses that are highly leveraged, which is basically just a fancy way of saying that these businesses carry a lot of debt. And this brings us to risk in investing. To me, share price volatility. So whether a stock's share price fluctuates more or less, well, that's not risk. What I would consider risk is the possibility of a permanent loss of capital. And what could cause a permanent loss of capital? Well, you guessed it, debt or leverage. In fact, I would argue that debt is probably the number one reason why businesses fail. And you can compare this to your personal life. When you buy too much stuff on credit, you can reach an amount of debt where you simply cannot pay it back. You might lose your job or maybe simply start making less money. And at some point, the interest payments become too overwhelming. And this is pretty much how corporate debt works as well. The same can happen to businesses. And that's why you want to avoid these highly leveraged companies. To give you one example here, Formula One was acquired by Liberty Media in 2017. And today, Formula One is one of the most global and most popular sports around the world and has an annual TV audience of over 500 million people. However, as far as I know, during the 2020 COVID pandemic, it was not entirely clear whether the motorsports business would survive, or at least the pandemic had put a lot of financial pressure on the F1 business model, but also the teams, of course, because the business simply carries a lot of debt, and as the pandemic has simply put a brake on many of its races. This might seem unimaginable to some, especially to hardcore Formula One fans, but during the pandemic it was unclear how big a risk the inevitable drop in income represented to the highly leveraged company Formula One. And this chart here, for example, compares Formula One's total liabilities to its operating income, which was actually negative during most years. And it shows the debt load Formula One has on its balance sheet. Of course, eventually Formula One was just fine and the sport might be more popular than ever right now. But personally, I would have a very hard time having or developing the conviction in a deeply cyclical business to hold onto the stocks in times of crisis. And as you all know, selling prematurely, and especially when the stock or a stock is down significantly, is usually, not always, but usually a losing strategy. And Formula One stock was down 50-something% during March 2020. Now just ask yourself if you would have been able to hold onto the business during this period of massive uncertainty. Now clearly debt works both ways. It leverages gains in good times, but it also magnifies losses in bad times. And if you want to compound your money over many years, usually decades, it's crucial to avoid major losses, and thus to place a lot of emphasis on the downside risk of your investments, and thus I try to avoid highly leveraged businesses. All right, and then a third type of company that investors should avoid, or at least be very careful about, are highly cyclical businesses. Cyclical companies usually see their profits soar when the economy is booming, but on the flip side, profits and revenues often collapse when the economy slows down. And cyclical companies often sell discretionary items and services that are in demand, as I said, during good times. But when there is a recession or an economic slowdown and consumers cut back on their spending, well, then revenues and profits collapse or go down. And the most commonly cited examples of cyclical companies, or industries I should say, are car makers, travel companies, airlines and hotels, restaurants, furniture businesses, or high-end clothing retailers. These businesses simply sell goods and services that people will likely cut first when times are getting tough. By contrast, businesses that sell consumer staples, so basic household products like groceries, toilet paper, or maybe generally hygiene products, will likely not see demand go down as drastically during downtimes. Of course, there are other industries such as the semiconductor industry that rely less on the purchasing power of end consumers, but are also notoriously cyclical. And that's because when supply conditions are favorable, chip makers, for example, often have trouble keeping up with demand and prices go through the roof. This is what we can see right now, actually, as there is a massive global chip shortage and chip makers are investing heavily to expand their current or set up new production capabilities. And they see record profits. But when supply eventually exceeds demand, as there's a pullback in demand or due to overproduction, chip prices fall and so profits decline steeply. Now, cyclical stocks are usually much more volatile than non-cyclical stocks, and thus they are traded quite heavily by many investors who try to buy them at the low point of their business cycle and sell them at the high point of the same cycle. The problem with this investment approach is that predicting when exactly a cyclical company's earnings or cash flow will peak or trough is notoriously difficult. It's simply very hard to estimate the stock's true earnings power when profits fluctuate quite heavily. And keep in mind that the intrinsic value of a company it reflects all future cash flows discounted back to present value at an appropriate discount rate. And personally, I find estimating future cash flows of cyclical companies incredibly challenging, and that's why valuing deeply cyclical businesses certainly requires a great deal of experience and an understanding of the industry the business is operating in. To quote Peter Lynch here, buying a cyclical after several years of record earnings and when the PE ratio has hit a low point is a proven method for losing half of your money in a short period of time. A classic example here would be video game maker Nintendo. The video game industry is or maybe was considered highly cyclical. And if we look at the past 15 years of financial history, we can see that Nintendo's revenue and cash flow from operations peaked in 2009. And back then, the stock was also trading at an incredibly low price to earnings multiple, as well as a very low price to revenue multiple. However, if we now take a look at Nintendo's stock chart, we can see that investors who bought Nintendo in 2009 were in for a pretty rough ride. And actually, the stock generated a negative return for a very long time. Now, interestingly, highly cyclical companies often also carry a lot of debt. And this brings us back to the second type of company that I try to avoid. If you combine company type 2 and 3, so firms with a lot of debt or financial leverage coupled with cyclical, often commodity-oriented businesses, you end up with a combination that can generate great returns, but you can also just as well end up in financial disaster. If you truly internalize Buffett's rule number 1, don't lose money, I think you have to avoid these types of investments. And to quote Christopher Brown here, in the bad times, cyclical companies with heavy debt loads may well face unsurmountable problems. Now let me add one honorable mention here. Deeply cyclical companies, they also tend to have very little pricing power. So in a way, by avoiding highly cyclical businesses, I also avoid businesses with no obvious moat. Companies that do possess a durable and strong moat usually have enormous pricing power and on average tend to be less cyclical, as these firms are price makers and not price takers. But that's a topic that deserves its own video, and I've actually talked about economic moats and the importance of different types of modes in a recent video of mine, so go check it out. And as always, may your finances and investments prosper. Good luck.